I could still remember my mom and dad telling me, when they paid 13% to finance a car for 48 months way back in like 1981. We live in a different world now. Now, if we ever see a repeat of very high interest rates, I'm worried that millions and millions of Americans would literally just stop buying homes, cars, appliances, etc. That will force corporations and small to medium-sized companies to lay off millions of people, since these companies they would not need that many employees due to low demand. We could see a depression similar to the one that we saw back in the 1930s. And according to experts, both interest rates and inflation could stay elevated for more than the markets realize. Here, check this out, guys.
Interest rates will stay higher than the market perhaps think they will today, but we are not too worried about that. Rates can be high as long as they're not going up dramatically. The market has digested the rates where they are today. Interestingly, the housing sector has digested where rates are today. Inflation may remain a little stickier as well, but it, in a sense, could be the good inflation, where we see workers changing jobs to get better wages, therefore having more spending power, but we don't see wage price spirals coming because it's not workers in the same jobs getting wage increases. And in fact, in addition, those wage increases are starting to moderate. So we think this bodes very well for, sluggish but continued economic growth.
It's amazing how she can just make high interest rates and record high inflation seem like such a good thing. What do you guys think? But right now, the Federal Reserve is on track to continue raising interest rates as they aim to tackle persistently high inflation. But it seems like we're nearing the end of this current economic cycle of monetary policy tightening. At least that's what some U.S. central bank officials were saying when they recently spoke about this situation. Since March of 2022, the Fed has increased interest rates by a whopping 5 percentage points to combat the highest U.S. inflation in 4 decades, folks. And I know you guys have been feeling it in everything from your credit cards to your bank loans. I mean, am I right? Now, since last month, policymakers, they decided to hold off on yet another rate increase to assess the impact of previous rate hikes on borrowing costs. But that doesn't mean that we're anywhere near being done. In fact, most officials still anticipate at least 2 more rate hikes being increased by the end of 2023. Now, what they're thinking is probably that a few more rate hikes are likely needed this year in order to bring inflation back down to the Fed's 2% target sustainably. Now, they're also balancing the risks of not doing enough and those of going overboard with the rate hikes. Now, as the data unfolds, the Fed may end up doing less, just enough, or maybe even too much, but they're going to have to let the data guide them. We still have the Federal Reserve's next meeting set for later this month. During this meeting, most investors and market analysts, they're expecting another rate hike that would ultimately bring the Federal Reserve rate policy up to 5.25 to 5.5% in that range. Now, the real question is whether they're going to be raising rates again in September, maybe wait until November, or possibly kind of hold steady and allow inflation to ease gradually. Fed Chair Jerome Powell has not ruled out consecutive rate hikes to combat stubbornly high inflation, which, if you look at the Fed's preferred metric, the Personal Consumption Expenditures Index, it has fallen from 7% last year to 3.8% in May, but still is nearly double the Fed's target. Now, some Fed officials are hopeful that we're going to be getting close to where we need to be. A survey by the New York Fed in June revealed that near-term inflation expectations have dropped to their lowest levels since April of 2021. Now, this could be a very good sign that price pressures are starting to ease, and it might take some pressure off the central bank to hike rates again. But hold on, guys, there's always a catch. There's always a catch, right? So the survey also showed that, expected home price gains have been on the rise for 15 consecutive months. So much for that housing market crash, right, guys? So basically, housing inflation might just rear its ugly head again and become a concern for the Fed at some point in the future. Now, some say that the Federal Reserve can afford to be patient with rates. That restrictive policy alone can actually bring down inflation without the central bank having to take any further action. Just kind of wait it out. But not everybody at the Federal Reserve is on the same page. Now, if it were up to them, they would basically have raised rates in that last meeting. But thankfully, they realized that, they need to kind of pull back a little bit on those rate hikes, or at least pause in order to align with market expectations. But let's actually see if they're going to stick to their guns that interest rates will need to go up, or maybe they're not ready to commit to anything or to make that happening at the July 25th, July 26th meeting just yet. Now, they're probably waiting to see more incoming data on the economy. But overall, the Fed's consensus seems to be at a half a percentage point more of additional tightening before the year's end. It's definitely something to think about, how governments they're going to be able to manage their debts when interest rates rise. Currently, they seem to be resorting to printing more money just to cover the interest. It's almost like a never-ending cycle. But if this keeps going, the debt figures could get pretty outrageous and very, very ugly, folks. Almost like a clown world scenario, Now, on top of that, we also have the challenge of demographic collapse and a decline in tax revenue. Now, it makes you wonder how governments will even survive the next decade unless interest rates stay below 1% after they've inflated away their debts. I guess something to think about, right? Definitely good reason to stick around, folks. In fact, why don't you go ahead and make it official? Go ahead and hit the subscribe button now and also tap that notification bell right after. And while you're here, I totally wouldn't mind a light, gentle tap of the like button either. Appreciate you guys so much for that. So yeah, let's go ahead and talk about the global hiking cycle and its impact on risk assets. It's been quite a ride over the last year, with central banks around the world raising rates left and right trying to combat inflation. This has led to one of the most rapid and concentrated hiking cycles that we've seen in decades. But what's next, right? What can we expect in the second half of 2023? Well, these questions are on the minds of investors, and it seems like there's no clear consensus on the answers. Now, if the recent history indicates a 40-year period, do previous cycles follow the same period? Will the next cycle follow the same rate of change, or is it likely to be compressed or steeper with a more shorter period? I wonder how the removal of reserve requirements and the creation of CBDCs is going to affect these 40-year cycles. But luckily for us, I have already looked it up for you guys. Different takes on where we currently stand in this global hiking cycle. So some experts are of the mindset that, while we might be nearing the end, it could still drag on into 2024. So brace yourself, folks, as there could be even more rate hikes before it's all said and done. U.S. Treasury yields are on the rise with the possibility of reaching 4.5% before the cycle comes to a close. But then again, there are a lot of different perspectives here. I mean, depending on the country and the various scenarios that could come into play. Now, as it stands, the Federal Reserve, the Fed, the European Central Bank, the ECB, and of course, the Bank of England, BOE, and some aligned countries like Switzerland might raise interest rates twice before the year is up. Now, the rate cycle might actually be reaching its peak, especially in the United States, where there could be a pause followed by a gradual reduction in high rates, as seen in the high yield curves. In Europe, we might witness further rate hikes at 25 to 50 basis points, except for the UK, where more increases are anticipated. But the UK may not see those expected rate hikes, especially if headline inflation starts to fall back, which seems likely right now. Even in the rest of Europe, there's a possibility that central banks will need to reverse some of their aggressive rate hikes if inflation softens a little bit and they start to see that their economy stalling a little bit with all this interest rate tightening. Now, of course, we have to talk about how all of this would impact your financial assets and, of course, your investment opportunities. Global bond markets are pricing in the likelihood of the hiking cycle coming to an end very, very soon. But, of course, there is the risk that it could stretch out into 2024. Now, that could be why we're seeing some stocks sell off lately. Same thing with the bond market, especially when the Federal Reserve took on a hawkish tone and the United States unexpectedly saw a surge in job creation. Now, interestingly enough, gold performed quite well recently, and it really didn't suffer very much from the higher rate environment. There's some short-term prospects for gold. Now, as for stocks, experts say that overall growth looks solid, so not much volatility is expected to continue in both equities and fixed income. Now, in the foreign exchange market, the US dollar, it remains weak against the euro. Now, this is probably going to continue if the central bank policies on both sides continue where they're going. The UK's pound sterling could also see some action against the US dollar, especially as the Bank of England takes a more hawkish stance due to higher and stickier inflation. Now, on the other hand, the Norwegian krone and the Swedish krona, they're expected to weaken further against the US dollar. Now, if we look at Europe, experts are predicting that if rates rise less or are cut more quickly, it could be positive for risk assets there, including equities, that's stocks for you guys. Keep an eye on those equity markets, guys, bond yields and exchange rates, and, let's see how it all unfolds in the next couple months. Now, to conclude, the experts basically see that the global hiking cycle, it's nearing its end. But they also agree that the major central banks will still likely raise interest rates further in the second half of the year. Higher interest rates push up the cost of credit, it decreases the present value of business, and it makes risk assets less attractive. So, additional rate increases this year, it can hurt asset prices, in particular stocks sensitive to rate changes such as growth and cyclical companies. But on the other hand, if central banks decide to raise rates by less than what the markets are currently expecting, or if they happen to cut rates more rapidly than anticipated, then these very same assets, they could see some tremendous price growth. That could mean some extra cash flow coming in, guys. Now, seriously though, despite all those doom and gloom predictions, the US economy has pulled off a surprise and it actually showed some pretty incredible resilience. Wall Street's dire forecast that we've been hearing so much about, nope, they haven't come true. And so now there's, quite a few reasons why this recession hasn't really shown up in the US economy. So first off, the Fed's monetary policy, it's keeping things relatively relaxed. They've managed to keep inflation-adjusted borrowing costs low, and of course, the Federal Reserve's balance sheet's looking pretty expansive. Not to mention, the government's been pretty much pumping money back into the economy, boosting investments, and providing a nice cushion. Now, those fixed-rate mortgages, they're also a total lifesaver, protecting borrowers from all these different rate hikes. Plus, consumer debt levels are under control. Kinda. And credit conditions, they're still looking pretty good for companies. More jobs are actually being added and jobless claims are lower than before the pandemic. Economic data is stabilizing too. And this is showing that the economy is on a steadier path. And so here's an interesting twist. Different parts of the economy have had their ups and downs, but they may have actually helped prevent a full-blown recession. The services sector is growing strong, offsetting any kind of slowdown in manufacturing. So yeah, all these different factors combined, they've made the economy super upbeat. And it's leaving everybody pretty much scratching their heads and wondering when the other shoe's gonna drop. I mean, am I right, guys? By the way, if you guys made it this far in the video, please consider dropping a like for the video. Also consider subscribing to the channel, and I look forward to seeing you guys on the next one.